So what if I told you that doing absolutely nothing with your retirement account this year?
Like literally not touching a single button.
Right, literally nothing. What if that could accidentally cost you like $400,000 and trigger a massive Medicare penalty?
It sounds completely backwards, I know.
It really does. But okay, let's unpack this because we're looking at a financial landscape where a lot of people's retirement portfolios are quietly turning into ticking time bombs.
And the really insidious part here is that they're turning into time bombs precisely because the stock market has been performing so incredibly well.
Yeah.
It's the absolute definition of a structural vulnerability just hiding in plain sight.
Which brings us to the mission for today's deep dive. We're pulling from some genuinely brilliant source material today.
Yeah, we are.
It's an episode of the 1715 Treasure Coast Financial Wellness Podcast.
Right. Hosted by Thomas Davies.
Exactly, from Davies Wealth Management. They're a fee-based fiduciary advisory firm out of Stuart, Florida. And the focus here is specifically on retirees who have built a portfolio of $2 million or more.
Which is a fantastic milestone, but it changes everything.
It really does. Managing that kind of wealth near all-time market highs requires, an entirely different playbook than what the average investor uses.
Completely different.
So we're going to extract the exact moves you need to protect your wealth, minimize taxes, and, secure your income for the next decade.
Because the contrast in the advice out there is, well, it's what makes this so critical.
Right.
If you read mass market financial articles, the conventional wisdom is usually just log into your account once a year and hit the rebalance button.
And getting an oil change.
Exactly. It's treated as this routine maintenance.
Yeah.
But when you scale up to that $2 million plus level, clicking that one automated button can actually trigger a catastrophic cascade of stealth taxes and penalties.
So let's start with why the portfolio gets out of whack in the first place. Because, it's a concept that completely defies common sense.
It goes against all our instincts.
Right. Usually when things are going great, you just don't mess with them. But here, a surging bull market is exactly what breaks your financial engine.
We refer to this mechanical breakdown as allocation drift.
Allocation drift. Okay, let's walk through how this actually happens to you.
Sure. So when you first retired, you and your advisor meticulously planned out your risk tolerance. Let's say you settled on a portfolio of 55% equities.
Which are your growth stocks.
Right. And then 45% bonds, which provide your safe, reliable income.
Fair.
That specific ratio was engineered to generate the cash you need while, heavily protecting your downside if the economy tanks.
But then U.S. large-cap stocks just go on an absolute tear.
Right, the market surges. And because your stocks grew exponentially faster than your bonds over a few years, your portfolio didn't just grow in total dollar value.
Its whole internal architecture warped.
Exactly. You never actually clicked a button to buy more stocks, but because of that uneven growth, the market basically did it for you.
Wow.
So your portfolio might now be sitting at 65 or, even 70% stocks.
I always think about this like loading a massive cargo ship.
Oh, that's a good analogy.
Right.
Yeah.
If you load it perfectly evenly, you can weather a hurricane. But if you're sailing through perfectly calm waters for a long time, and the cargo silently shifts heavily to one side.
You don't even notice.
Exactly. The sun is shining, the ship is moving fast, but the second a sudden storm hits, that off-balance weight will absolutely capsize you. And the problem here is just the sheer scale of the math.
Yeah, to put hard numbers on that shifting cargo, the source data lays out a really specific scenario.
Let's hear it.
If you have a $2.5 million portfolio and it drifts from 55% equities up to 65%.
Which doesn't sound like a lot on paper.
It doesn't, but that is $250,000 in completely unplanned market risk.
Wow.
You are exposing $250,000 to stock market volatility that you never actually consented to take.
And the consequences just scale up violently.
Yeah.
If you have a $200,000 IRA and the market drops 20%, you might lose $40,000.
Right. It stings, but you have time to recover.
But if you have a $2 million plus portfolio, a 20% correction means you were losing $400,000 or more in a matter of weeks.
Which fundamentally alters your entire retirement timeline.
Yeah.
Because when you're retired, you no longer have decades of future wage income to bail you out of a massive drawdown.
You can't just ask your boss for overtime.
Exactly. Or work an extra 5 years to magically replenish a $400,000 loss.
But wait, I have to push back on this a little because human nature is kind of screaming at us right now.
Oh, absolutely.
If the market is hitting all-time highs And my portfolio is ballooning specifically because my tech stocks are doing incredibly well.
Right.
Aren't we basically complaining about making too much money? I mean, if the winners are winning, why not just let it ride?
It is the most natural human instinct in the world to want to let it ride. It's driven heavily by recency bias, this belief that whatever the market is doing today, it'll just keep doing tomorrow.
Right, of course.
But Vanguard has actually published extensive academic research on this exact behavioral dilemma.
Oh, really?
Yeah. And their findings completely reframe the conversation. Portfolio rebalancing is not designed to get you higher returns.
Oh.
It is a pure risk management tool.
Oh, wow. So trimming your winners isn't a growth strategy at all. It's literally an insurance policy.
Exactly. Rebalancing near market highs is essentially buying insurance against the specific risk that matters most to you right now.
Which is experiencing a massive, unrecoverable loss early in your retirement.
You got it. You are selling high to lock in those gains and purchase stability.
Okay, so the cargo is dangerously heavy on one side, and we absolutely have to move it back to the center to avoid capsizing.
Right.
But that introduces this massive new tension. How do we move all that money around without the IRS showing up to take a huge cut of the profits?
And that's the multi-million-dollar question.
Right, because if you just log into your taxable brokerage account today and sell $300,000 of highly appreciated stock to buy bonds.
You are going to generate a brutal capital gains tax bill.
Exactly. So how do we fix it?
The solution is to stop looking at your accounts in isolation. You have to start playing three-dimensional chess with your asset location.
Three-dimensional chess, I like that.
It relies on the fact that high net worth retirees usually don't just have one big account. They typically have three distinct tax buckets.
Right, so you have your taxable brokerage accounts, your tax-deferred accounts like your traditional IRAs or 401ks,
Right.
and your tax-free accounts, which are your Roth IRAs.
Exactly. And the secret here is that the IRS doesn't care which account holds your bonds as long as your overall household portfolio has the right mix.
Oh, that holistic view is critical.
It really is. So instead of selling your big tech winners in your taxable account and triggering capital gains, you look over at your IRA. If you are required to take required minimum distributions, your RMDs,
Right.
you deliberately pull that cash exclusively from the bond side of your IRA. By doing that, you automatically lower your overall household bond weighting and bring the stocks back into balance.
That is so smart. Or better yet, you just buy the replacement bonds inside your Roth IRA, where there are absolutely no tax consequences for the transaction.
Exactly.
You're effectively moving money between your left and right pockets to legally bypass the IRS.
And you can even take this a step further with tools like qualified charitable distributions or PCDs.
Oh, right.
If you're charitably inclined and over age 70 and a half, you can transfer funds directly from your traditional IRA to a qualified charity.
Which satisfies your RMD.
Yes, it satisfies the RMD, it rebalances your portfolio by moving out the specific assets, and the best part,
What?
it never shows up on your tax return as adjusted gross income. The savings from these cross-account moves are staggering. By executing trades in the tax-advantaged buckets to balance out the overall portfolio, you can save anywhere from $10,000 to $50,000 or more in unnecessary taxes compared to just doing a brute force trade in a single taxable account.
This leads perfectly into a strategy that completely flips traditional tax advice on its head.
Oh yeah, this is a fun one.
Because usually we hear about tax loss harvesting, right? Selling your losers to offset your gains. But the Davies Wealth Management Framework heavily emphasizes tax gain harvesting.
Yes, it does.
Wait, so you're actively forcing a taxable event on purpose just to raise the floor on your cost basis.
That's exactly what you're doing.
But it goes against everything we're normally taught about delaying taxes as long as possible.
It absolutely goes against conventional wisdom, which is why it's such a powerful overlooked tool.
But
There is. It requires a very specific environmental condition. You have to be in what we call the gap years.
okay, let's explain those gap years because the legislative landscape has shifted a lot recently.
It really has. So, under the new Secure 2.0 rules, the age where you are legally forced to take money out of your IRA, your RMD age,
Right.
that's been pushed back to 73.
Wow. Okay.
So if you retire at 65 and you delay claiming Social Security until age 70, you have this multi-year window where your actual forced taxable income plummets to almost zero.
And this is where the cheat code activates.
Yes, it is.
Because in 2026, the 0% long-term capital gains threshold for a married couple filing jointly is roughly $1,050.
Think about the mechanics of that. If your taxable income is sitting below that $94,000 threshold during your gap years,
Yeah.
you can intentionally sell highly appreciated stocks from your taxable account, legally realize those massive gains, and pay exactly 0% in federal capital gains tax.
And then you just turn around and immediately buy those exact same stocks back.
Precisely. What you've accomplished is a cost basis reset.
Right.
Let's say you originally bought the stock for $50,000 and it grew to $150,000. Normally, you owe taxes on that $100,000 of growth. But by selling it at 0% and repurchasing it for $150,000, your new baseline is $150,000.
You just completely washed away $100,000 of future tax liability.
Exactly. For a multi-million-dollar portfolio, systematically resetting the basis like this over several years can easily preserve $50,000 or more in wealth.
It's a brilliant maneuver, but anytime a strategy feels this powerful, I start looking for the catch.
Naturally.
Are we going to trip over a hidden wire by generating all these paper gains?
You are absolutely right to be cautious because there is a massive hidden wire, and it's called your MGI.
Your modified adjusted gross income.
Right. Even if you pay a 0% actual tax rate on those capital gains, the IRS still counts every single dollar of that realized gain as income when calculating your MGI for the year.
Oh, and your MGI is the trigger for the stealth taxes,
Yeah.
specifically the IRMAA trap.
Yes. Medicare's income-related monthly adjustment amount. IRMAA is essentially a penalty tax levied on higher income retirees, and it functions like a cliff.
Okay.
In 2026, IRMAA surcharges kick in when a married couple's MHI crosses approximately $212,000.
And crucially, there's a 2-year look-back period, isn't there?
Yes. So the income you show on your tax return in 2024 completely dictates the Medicare premiums you will be forced to pay in 2026.
So let's run a disaster scenario to see how rebalancing blindly can just blow up in your face.
Okay, let's do it.
You have a $2.5 million portfolio. You decide you need to reduce your stock exposure, so you just log in and sell $300,000 of stock in your taxable account.
Right.
That trade alone generates, say, $150,000 in capital gains. Add that to your baseline retirement income, and you just blew right past that $212,000 MGI cliff.
You didn't just blow past it. You likely triggered multiple escalating tiers of IRMA surcharges.
Wow.
That one single rebalancing trade could easily cost you an additional $4,000 to $12,000 a year in forced Medicare premiums.
It's helpful to think of your MGI like a strict electrical circuit breaker for your tax year.
Oh, I like that.
It's like plugging a space heater into an outlet that's already running a heavy-duty microwave.
Perfect analogy.
Right. Because a lot of affluent retirees are actively executing Roth conversion ladders. They're converting traditional IRA money over to Roth accounts up to the top of the 24% tax bracket.
Which is around $383,900 for a married couple in 2026.
Right. So in our analogy, the Roth conversion is the microwave. The capital gains from rebalancing is the space heater.
And if you run both of them on the exact same circuit at the exact same time,
You blow the IRMAA circuit breaker and get hit with a massive penalty.
that is the perfect way to visualize it. You have a strict capacity on that circuit. You have to account for pensions, Social Security, Roth conversions, and any capital gains.
Wow.
This is why the source material intentionally contrasts a $300,000 portfolio with a $3 million portfolio.
How so?
Well, if you have a $300,000 portfolio, a 10% rebalance is a $30,000 trade. The capital gains might be $15,000.
Right. That's not going to blow the circuit breaker.
Exactly. But at $3 million, a 10% shift means moving $300,000. The risk is severe, and the coordination across accounts has to be flawless.
Okay, but paying a fiduciary to meticulously model tax software and dodge all these tripwires sounds incredibly complex.
Right.
What if you just want to fix the drift organically without triggering a single tax event or doing any complicated basis resets?
Then we rely on the elegance of natural rebalancing.
Natural rebalancing.
Yes. This uses your everyday cash flows to do the heavy lifting for you.
Okay.
If you're actively withdrawing money to live on, every single withdrawal is an opportunity to correct your trajectory.
Let's walk through the mechanics of that.
Sure.
Say you are pulling $120,000 a year from your $3 million portfolio to fund your lifestyle.
Yeah.
Usually, a basic system just pulls that proportionally across all your investments.
Right.
But if your stocks are running way too hot because the market is at all-time highs, You step in and pull that entire $120,000 exclusively from your overweighted stock positions.
Exactly. Because you are already pulling the money out to spend it, you are going to pay taxes on that distribution anyway.
So there's zero incremental tax costs.
None. And a $120,000 withdrawal on a $3 million portfolio is 4%.
Okay.
By doing this strategically over the course of a year, you can shift your overall equity allocation downward by 3 to 4 percentage points without making a single taxable rebalancing trade.
And you can amplify that by redirecting the dividends.
Oh, absolutely.
If your portfolio kicks out $60,000 in dividends, turn off the automatic reinvestment. Don't let that cash automatically buy more of the exact same stocks that are already overweight.
Right. Funnel those dividends directly into the underweight bond side.
You're slowly shifting the cargo while the ship is moving, and you completely avoid the behavioral discomfort of having to make one massive, scary trade.
It is highly efficient. But, all of this maneuvering raises an incredibly important contrarian question.
What's that?
With all these complex levers available to pull cross-account strategies, gain harvesting, natural cash flows, when is the correct move to step away from the controls completely and do absolutely nothing?
Right, because hypermanaging a portfolio can be just as dangerous as ignoring it. If you jump out of your chair and rebalance every time your allocation shifts by a fraction of a percent, you're going to bleed yourself dry.
You are. Momentum is a very real factor in the markets.
Yeah.
Research consistently shows that markets hitting all-time highs often go on to produce positive returns over the subsequent 12 months.
Really?
Yes. So if you rebalance too early or too aggressively, you're just repeatedly chopping the heads off your biggest winners to buy assets that are currently lagging.
Not to mention, every trade carries transaction friction.
Exactly. Trading costs, bid-ask spreads, and minor fractional tax drag.
So there has to be a mathematical threshold where the friction outpaces the benefit.
The source provides a very clear hierarchy of drift thresholds to guide this.
Okay, let's hear the hierarchy.
If your portfolio has drifted 0 to 3% from its target allocation, you do nothing.
Nothing at all.
The transaction costs and the tax friction simply aren't worth the microscopic reduction in risk. Just sit on your hands.
That makes sense. And as it creeps up,
At 3 to 5% drift, you activate the natural rebalancing we just discussed, redirecting your cash flows and dividends to gently nudge it back.
okay,
At 5 to 10% drift, you are in active rebalancing territory, prioritizing those surgical cross-account strategies to shield the moves from taxes.
and if it crosses 10%,
That requires priority action. Your structural risk profile has materially changed, and the danger of a sudden market correction wiping out years of wealth is now critical.
but that introduces a massive tension regarding estate planning, specifically this concept of the stepped-up basis.
Ah, yes, the step-up basis.
Let's explore this because it's a huge counter-argument.
Yeah.
If I hold on to these highly appreciated stocks in my taxable account until I pass away, the tax code allows the cost basis to step up to the current market value for my heirs.
Right.
So they inherit millions of dollars completely tax-free. Am I supposed to sacrifice my own retirement safety net,
Yeah.
sell the stocks, pay some taxes, and give up that incredible gift to my kids?
It is a profound emotional and financial tension that almost every high net worth family grapples with,
I can imagine.
especially right now with the estate tax exemptions sitting at historic highs, around $13.61 million per person in 2026.
Right.
The tax benefit to the next generation is undeniable. However, you have to weigh that against the catastrophic cost of inaction.
Okay.
Legacy goals should always complement your retirement security, but they must never override it.
Because if the market crashes and your portfolio gets cut in half, the fact that your kids get a stepped-up basis doesn't buy your groceries today.
Exactly. And this introduces the most terrifying mathematical concept in retirement planning. Sequence of returns risk.
Okay, sequence of returns risk.
It is the specific danger of experiencing a major bear market early in your retirement while you are simultaneously withdrawing assets to live on.
Let's walk through the mechanics of that risk, because the example from Davies Wealth Management is jarring.
It really is.
Let's say you have a $3 million portfolio. You let it drift because you want to leave a stepped-up basis to your kids, so you're sitting at 70% equities.
Right.
Suddenly, the market takes a severe 30% correction. What actually happens to your money?
If your overall portfolio is overly concentrated in equities and experiences that steep drop, while you are simultaneously forced to withdraw, say, $150,000 to fund your lifestyle,
Yeah.
your portfolio plummets to roughly $2.22 million.
Ouch.
you have lost a staggering amount of capital. But worse than that, because you are actively pulling money out at the absolute bottom of the market, you are locking in those pipper losses permanently.
Right, because you were selling twice as many shares to generate that same $150,000.
Exactly. The mathematical reality of recovering that wealth becomes incredibly bleak.
Now compare that to the retiree who actually did the maintenance.
Yeah.
They managed the drift, executed the cross-account strategies, and kept their portfolio safely centered at 55% equities before the storm hit.
They still experience the pain of the market drop, yes. No one is immune to a crash.
Sure.
But because their bonds provided a shock absorber, their portfolio holds at approximately $2.35 million.
That is a $135,000 difference in preserved wealth.
Yes, that $135,000 is nearly a full year of retirement income completely protected, simply because they had the discipline to rebalance the portfolio when the waters were calm.
Wow.
A stepped-up basis for your heirs means absolutely nothing if sequence of returns risk forces you to sell off the family wealth at severely depressed prices just to sustain your own life.
So managing a $2 million plus portfolio near all-time highs is absolutely not about reacting emotionally to whatever economic headline is flashing on the news today.
Not at all.
It is a highly coordinated, multi-layered defense of your lifestyle. It requires you to act systematically.
Yes, it does.
You have to measure the drift against those clear thresholds. You have to model the tax impacts across all three buckets to avoid blowing the IRMAA circuit breaker.
Right.
And you have to map out a strategy to execute logically.
And, executing that logic requires overriding some very powerful human instincts.
Definitely.
Fiduciary advisors are legally obligated to do what is in your best financial interest, unlike a standard broker who might just be selling products.
Right.
And what's fascinating is that acting in your best interest often means forcing you to do the exact opposite of what your brain wants you to do.
Because your brain is looking at a tech stock that's up 40% screaming, "This is making me rich, don't touch it."
Precisely. Proper risk management requires you to sell your absolute best performing assets right at their absolute peak and use that money to buy the boring conservative assets that have been underperforming. So the question I would leave you with as you review your own accounts is this. How do you train yourself to trust the cold, hard math over your own psychological instincts, especially when the stakes are literally in the millions of dollars?
It's the ultimate test of financial discipline. I mean, you can't just let the cargo keep shifting in the sunshine and hope the weather stays perfectly calm forever.
No, you can't.
Eventually, you have to go down into the hull of that ship, look honestly at the weight distribution, and do the heavy lifting to move things back to center. Because when the storm finally does hit, and historically it always does, you want to know that your ship is engineered to sail right through it.